This is Michael Langemeyer. Today I'm going to be reporting on the June Ag Economy Barometer results, which will be released July 7th, 2026. Let's start with the Ag Economy Barometer Index itself. The Ag Economy Barometer Index declined from 119 in May to 113 in June, so a 6-point decline. This month, the decline was both in the index of current conditions and the index of future expectations. Both of them declined approximately 5 points. And this is important because we expected the index of current conditions to drop a little bit because corn prices weakened from mid-May to mid-June, as well as soybean prices. And typically when that happens, you see some softening in the index of current conditions. But it's important to point out is that we also saw that decline in the index of future expectations. And so we'll cover some slides today that kind of cover why both of those indices may have dropped. I'd like to start with a graph that shows a question as follows. What is the main thing limiting improvements in your farm's financial situation? Overwhelmingly, the most common answer was high input costs. 42% of the respondents indicated high input costs was the main thing limiting their financial performance. That was followed a very distant second by low output prices, about 17%. Other things they could pick from was weather risk, policy uncertainty, debt or financial pressure, labor and equipment concerns. I would like to note that even though it was a fairly low percent, there was 8% that indicated the main thing limiting their improvement in farm's financial position is debt or financial pressure. And so that's interesting that 8% said that was their most limiting factor. When you look at the Farm Financial Performance Indexes, which is really trying to compare financial performance this year with financial performance next year. So is your financial performance going to improve in the next 12 months? This index is below 100, saying that they think their financial performance is going to decline in the next 12 months. And financial performance is already relatively low, particularly for crop producers. And so I think this is very important in explaining both the index of current conditions as well as the index of future expectations. If this index was a little closer to 100, we would have not seen the weakness in both of those indices. I also want to talk about Farm Capital Investment Index. It dropped 1 point to 40, and so the decline was not very big compared to May. But as you can see from the chart, it's down quite a bit from what it was in 2025. And this is actually the lowest reading on this index since late 2024. And so it's been a while since we've had an index as low as 40. If you go back into 2024, particularly before the 2024 national election, this index was below 40. And so that's fairly low. And this obviously means that a lot of people are not particularly enthused about making machinery, equipment, and building purchases in the current economic environment. We asked a couple questions related to artificial intelligence or data-driven tools in agriculture. The first question was really asking people what they thought was the main benefit from artificial intelligence and data-driven tools. We haven't asked this question before, so we really didn't know what they were going to tell us, but it's important to point out that 52% said no benefit. And I think there will be meaningful benefits, but at least at this point, the majority of the respondents really haven't figured out how the AI or data-driven tools is going to help their operation. If you look at the choices in terms of improving their operation or benefiting their operation, we listed reducing labor, reducing risk or uncertainty, and increasing production. Of those three, 23% said it would increase production, and that was a higher percent than reducing labor or reducing risk and uncertainty. AI gets a lot of press these days, and a lot of times they're focusing on that labor. And so we'd like to point out that only 14% thought that AI or data-driven tools was going to reduce labor. We're going to ask this question down the road again periodically to see if these answers change in the future. And I think they will. I think there'll be a higher percent that believe these tools are going to benefit their operation. We had a second question, and this question is coming from Chad Fichter. He also came up with the first AI question. If you use AI to make a recommendation, is it going to be difficult to follow that recommendation because something's going on the farm that makes it difficult to follow that recommendation? An example would be, let's say there's a recommendation to plant corn and soybeans at a particular time. What if it rains? What if conditions change? And so optimal timing may change based on facts on the ground. And so that's what this question is getting at. The question reads as follows. How often would data-driven recommendations be difficult to follow because of labor, equipment, or timing constraints? And notice that sometimes was 63% and often was 22%. And so again, there's going to be a learning curve with these data-driven tools, and at least they may be difficult to follow the prescription precisely. We also asked a couple questions this month about information related to farmers' suppliers. Here's the first question. What is the main value you get from your suppliers? The most common response was reliable service and availability, followed by advice or expertise, a lower or competitive price, or financing or flexibility. And so I thought that was interesting. And again, we're going to ask this question again in a few months to see if the responses are similar. We followed that up with another question related to suppliers. This one is really related to concentration in the input supply industry. If you had more supplier options, do you think your financial outcomes would be about the same, slightly better, or much better? And notice here that 31% said slightly better and 9% said much better. And so there is definitely a group of respondents think that their outcomes would be better if they had more input supplier choices. As we do in most months, in particular since January 2019, we asked a question related to agriculture exports over the next 5 years. Do you think exports are likely to increase, decrease, or remain about the same? 43% said they're going to increase and 9% said decrease. You can see in this chart that the percent that expect them to decrease is quite a bit lower than what it was in late 24 and early 25. And so there's quite a bit of optimism regarding agriculture exports at the present time. We also asked a question about free trade. We've asked this question before. Specifically, we asked it in 2020, we asked it in 2025, and really the answers were very consistent with the previous times we've asked this question. 85%, the overwhelming majority of producers think that free trade benefits agriculture and other industries. And so I think that's also a very important question in the current trade environment where there's been imposition of tariffs or suggestions that we have tariffs on trade goods. And so this question kind of says that it may not be the best idea. We also have been asking a question for the last several months, ever since July 2025 specifically, about the direction the country's going in. Specifically, would you say things in the U.S. today are generally headed in the right direction or on the wrong track? Just like May, the percent that say we're heading in the right direction is much, much lower than what it was for the last 6 months of 25, where it ranged from 67 to 75%, and 75% being December. Now we're in that 52 to 53% of respondents think we're heading in the right direction. I think this question is important to think about when you're thinking about the long-run policy environment and specifically the long-run future expectations index. The future expectations index is likely lower in May and June, particularly this month, because of the answer to this question. People are more pessimistic about the direction of the country. They're probably going to be more pessimistic about their future expectations. I want to turn to a couple questions that are more optimistic, if you will. As I said, the Ag Economy Barometer index was down, sentiment was down. That was true both in the index of current conditions, the index of future expectations. So both short run and long run sentiment is down. What's not down is sentiment related to land values. The short-term farmland value expectations index declined a little bit, but it's still very steady. It's been very steady during the last year and it hasn't come close to that index of 100. If we have an index of 100, that means the same percent of people think that land values are going to increase as expect land values to decrease in the next 12 months. But the current index suggests that there's substantially more people that think land values are going to increase in the next 12 months than decrease in the next 12 months. And so I would regard that as relatively optimistic regarding short-term land values. We achieved a record in terms of the long-term farmland value expectations index at 166. It matched the previous record that occurred one of the months in 2025. And so there's a lot of optimism regarding where land values may be in the next 5 years. To me, there's a conflict here between the index of future expectations being relatively weak and this land value question. Usually they're tied more closely together. And so the only way I can begin to interpret that is to think that the future expectations index is really more on what's happening to prices. If you look at futures prices for corn and soybeans, for example, they're not particularly high. We certainly don't see a ratchet up of those prices anytime soon. That would lead fairly sour sentiment regarding the next few years. On the other hand, they think that land values are going to hold steady because land values involve more than just prices. Specifically, when we ask people to list the factors that are impacting land values, the factor that's most commonly indicated by the respondents is the importance of outside investors. And so when they list the factors impacting land values, outside investors or interest from outside investors is always ranked as the most important factor, followed by net farm income, interest rates, and inflation. I think what's going on here is that even though they think there might be some weakness in corn and soybean prices and wheat prices in particular, they don't think that's going to translate into a reduction in land values in the next 5 years. I'll leave it at that. I think that result is quite interesting. And of course, we'll be monitoring that development in future surveys. So today I summarized the Ag Economy Barometer results for June. And again, these results are released July 7th, 2026. I encourage you to check out the website for the Center for Commercial Agriculture and the Ag Economy Barometer website for more information.